I want to ask you a question that sounds simple but has an answer so disturbing that most people never think about it. If you look at America today, nearly every American owes money to someone. The average household carries over $100,000 in debt when you add up mortgages, car loans, credit cards, and student loans. The federal government owes $34 trillion. State and local governments owe trillions more. Corporations owe over $10 trillion. Add it all up, and Americans collectively owe more than $70 trillion. That's a staggering number, more than 3 times our entire annual economic output. But here's the question that should haunt you. If everyone is in debt, who's the creditor? Who holds all these IOUs? Where did all this money come from that everyone borrowed? The answer to this question reveals something so fundamental about how our financial system actually works that once you understand it, you'll never look at money, debt, or the economy the same way again. And I promise you, the answer is not what you think. Most people, if you ask them who Americans owe money to, they'll give you obvious answers. China, right? We hear constantly that China owns American debt. Japan also holds a lot of treasury bonds. Oil-rich countries in the Middle East. Foreign creditors lending to profligate Americans. And yes, foreign entities do hold some American debt, but far less than most people imagine. Foreign governments and institutions hold about $8 trillion in U.S. Treasury securities. That sounds like a lot, and it is, but it's less than a quarter of total federal debt and a tiny fraction of total American debt. So if foreigners aren't the primary creditors, who is? Some people will say banks. Americans borrow from banks, so banks must be the creditors. And that's partially true. Banks do hold some debt on their balance sheets. But here's where it gets interesting. Where did the banks get the money they lent out? You might think they're lending out depositors' money, taking money from people with savings and lending it to borrowers. That's certainly what I thought for the first few years of my career. It's what they teach in basic economics textbooks. But it's not actually how the banking system works. And this is crucial to understand. When a bank makes a loan, they don't take money from someone else's account and transfer it to the borrower. That's not the mechanism. Instead, they simply create a new deposit in the borrower's account. They literally create money out of thin air with a few keystrokes. You walk into a bank, apply for a $50,000 car loan, they approve it, and suddenly you have $50,000 in your account. That money didn't come from anywhere. It didn't exist before. The bank created it by making the loan. Your obligation to repay the loan, your promise to pay $50,000 plus interest over the next 5 years, that becomes the asset on the bank's balance sheet. And the deposit in your account, the money you now have to spend, that's the liability on the bank's balance sheet. This sounds insane when you first hear it. How can banks just create money? Isn't that counterfeiting? Isn't that fraud? But it's completely legal, and it's how the fractional reserve banking system has operated for over a century. Banks are only required to hold a small fraction of their deposits as reserves, typically around 10% historically, though the Federal Reserve actually reduced the reserve requirement to 0 during COVID, and it remains there today, 0. Banks don't need to hold any reserves at all against deposits. They can create as much money through lending as they want, as long as they can find willing borrowers and as long as they maintain certain capital ratios. So when Americans borrow money from banks, we're not really borrowing existing money. We're calling new money into existence through the act of borrowing. The bank becomes the creditor, yes, but they're a creditor who created the thing they lent you out of nothing. The money supply expands every time a bank makes a loan. And here's the really crazy part. The money supply contracts when loans are repaid. When you make your monthly car payment, that money doesn't go into some vault at the bank. It essentially disappears. The bank's asset, your outstanding loan balance, decreases. The liability, the deposit you're using to pay, decreases. The net money in the system shrinks. This means the entire monetary system is fundamentally based on perpetual expansion of debt. If everyone tried to pay off their debts simultaneously, if Americans collectively decided to eliminate all private debt, the money supply would collapse. There wouldn't be enough money in existence to conduct normal economic activity. We'd face severe deflation, economic depression, mass unemployment. The system requires continuous growth in debt just to maintain stability. It's a treadmill we can never get off. But banks aren't the only creditors creating money from nothing. The Federal Reserve, America's central bank, takes this to another level entirely. When the federal government spends more than it collects in taxes, which it has done for the vast majority of the past 50 years, it issues treasury bonds to cover the deficit. Who buys those bonds? Various entities, including foreign governments, pension funds, insurance companies, and regular investors. But increasingly, especially since the 2008 financial crisis, the largest buyer of treasury bonds has been the Federal Reserve itself. The mechanics of this are important to understand. The Treasury issues a bond, essentially an IOU from the government, promising to repay the money with interest. The Federal Reserve buys that bond by crediting the Treasury's account at the Fed with newly created money. The Fed doesn't have to get this money from anywhere. They don't tax anyone. They don't borrow from anyone. They literally just add numbers to the Treasury's account, digital entries in a computer system. The Treasury then spends this money into the economy, paying government employees, funding programs, buying weapons, whatever. And now that money exists in the economy. People have it in their bank accounts. Businesses have it. It's real spendable money. But where did it come from? It came from nothing. The Federal Reserve created it. And in exchange, the Fed now holds a Treasury bond, an obligation from the U.S. government to pay back this money that was created from nothing. Do you see the circular logic here? The government owes money to the Federal Reserve, which is itself a creation of the government. The government effectively owes money to itself, or more precisely, to an institution it created that has the power to create money from nothing. This process, where the central bank buys government bonds with newly created money, is called monetizing the debt. And it's been happening on a massive scale for the past 15 years. During the quantitative easing programs after the 2008 crisis, the Federal Reserve's balance sheet expanded from less than $1 trillion to over $8 trillion. $8 trillion of Treasury bonds and mortgage-backed securities that the Fed purchased with money created from nothing.
During COVID, they did it again, adding trillions more to their balance sheet in a matter of months to fund government stimulus programs. So who's the creditor for federal government debt?
Increasingly, it's the Federal Reserve, which means ultimately it's just created money backed by nothing except the government's promise to repay itself using money it can create. It's circular, it's almost metaphysical. It challenges your basic understanding of what money even is. Now let's talk about another major creditor in the system, pension funds and insurance companies. These institutions hold enormous amounts of American debt, both government bonds and corporate bonds. They need these safe, stable investments to match their long-term liabilities, the pensions they need to pay to retirees, and the insurance claims they need to cover. But here's what makes this interesting. Where did pension funds get the money to buy all these bonds? From workers' wages. A portion of every paycheck gets set aside for retirement, accumulates in a pension fund, and gets invested in bonds and stocks. So, in a sense, American workers are creditors to the American government and to American corporations. We owe ourselves. The government's debt is held by pension funds that represent workers' retirement savings. Corporate debt is held by those same pension funds. We're simultaneously the borrowers and the lenders in the system. This might sound sustainable, a closed loop where Americans owe money to Americans, but it creates a dangerous dynamic. When the debts go bad, when borrowers default, the losses fall on pension funds, which means they fall on retirees who are counting on those pensions. The wealth destruction doesn't disappear. It just gets shifted to a different group of people, usually people who can least afford it. Let me give you another piece of the puzzle, money market funds and mutual funds. Americans have trillions of dollars in these funds, thinking they're saving and investing. But what are those funds doing with the money? They're buying treasury bonds, corporate bonds, mortgage-backed securities. They're essentially lending American savings right back to other Americans, to corporations, to the government. Again, we're borrowing from ourselves, intermediated through financial institutions that take a fee for facilitating the process. And then there's the mortgage market, which is particularly fascinating in terms of understanding who the creditor really is. And most Americans with mortgages think they owe money to a bank or a mortgage company. And legally, they do. But economically, the reality is different. Most mortgages get sold shortly after origination. The bank that gave you the mortgage packages it with thousands of other mortgages into a mortgage-backed security and sells that security to investors. Who are these investors? Pension funds, mutual funds, foreign investors, and massively the Federal Reserve. During the housing crisis and its aftermath, the Federal Reserve bought over $2 trillion in mortgage-backed securities. $2 trillion. They created money from nothing and used it to buy mortgage debt from American homeowners. So who do Americans with mortgages really owe money to? Ultimately, many owe it to the Federal Reserve, which means they owe it to an institution that created the money from nothing. The circular logic appears again. Americans borrowed money that was created from nothing, and they're paying it back with dollars they earned through labor, real effort and time to retire debt that never really existed in the first place except as accounting entries. Now, I want to address something that might be forming in your mind. If all this debt is owed to ourselves, if the money was created from nothing, why does it matter? Why can't we just forgive all the debt, wipe the slate clean, start over? And this is where we confront the brutal reality of how the system actually functions. The debt might be notional, might be created from nothing, but the obligation is very real. If you don't pay your mortgage, you lose your house. If you don't pay your car loan, they repossess your car. If you don't pay your credit cards, your credit score gets destroyed and they can garnish your wages. The consequences of not paying are severe and immediate for individuals. The debt might be fictional in origin, but the enforcement is real. For the government, the dynamic is different, but equally binding. If the government stopped paying its debts, if it defaulted on treasury bonds, the consequences would be catastrophic. Interest rates would spike, the dollar would collapse, the financial system would seize up, foreign investors would flee. It would make the 2008 crisis look like a minor inconvenience. So even though the government could theoretically create infinite money to pay its debts, and even though much of that debt is owed to the Federal Reserve, which could theoretically forgive it, the system can't allow that to happen because it would destroy confidence in the currency and the entire financial system. This is the trap. We're stuck in a system where debt must continuously grow to prevent collapse, but growing debt eventually becomes unsustainable, which also leads to collapse. It's a choice between immediate catastrophe and delayed catastrophe. And predictably, humans always choose delayed catastrophe. We'll keep expanding debt, keep creating money, keep pretending the system is sustainable until the day we can't anymore. Let me connect this back to my original question. If every American is in debt, who's the creditor? The answer is that we're trapped in a circular system where creditors and debtors are often the same people, just in different roles. You owe money on your mortgage, but your pension fund holds mortgage-backed securities, so you also own mortgages. The government owes money on treasury bonds, but the Federal Reserve owns those bonds, and the Federal Reserve is an extension of the government. Corporations owe money to bondholders, but those bondholders are mutual funds and pension funds representing ordinary Americans. We've created a financial system that's fundamentally circular, where money is loaned into existence and debts are owed to entities that created money from nothing. The system functions as long as confidence is maintained, as long as everyone believes the dollars have value and the debts will be repaid. But it's built on belief, not on anything tangible. There's no gold backing the dollars. There's no real assets backing most of the debt. It's trust and legal enforcement holding the entire structure together. And here's what terrifies me. After spending 84 years studying this system, the amount of debt has grown so large relative to the real economy, relative to actual productive capacity, that maintaining confidence is becoming harder every year. When federal debt exceeds $34 trillion and continues growing by over $1 trillion per year, when household debt exceeds $15 trillion, when corporate debt exceeds $10 trillion, when state and local governments owe trillions more, the numbers become absurd. They lose meaning. How does anyone repay $34 trillion? They don't. They can't. The only option is to create more money and hope inflation doesn't spiral out of control. But creating more money is itself confidence destroying. When people realize that dollars are being created in massive quantities to service unpayable debts, they start to question why they should accept those dollars as payment. Why should I work for 40 hours and accept payment in dollars if those dollars are being created by the trillions with no backing? Why should I sell my house or my car or my business for dollars that might be worth half as much next year? When confidence breaks, when people reject the currency, that's when the system collapses. We saw previews of this dynamic during the inflation surge of 2021 and 22, when inflation reached levels not seen since the early 1980s. That was caused by excessive money creation during COVID, when the government spent over $5 trillion in stimulus and the Federal Reserve expanded its balance sheet by several trillion dollars. Too much money chasing too few goods. People started to lose confidence in the dollar's purchasing power. The Fed had to raise interest rates aggressively to restore confidence, but that tightening is now threatening to trigger a debt crisis. It's an impossible situation. Create too much money and you get inflation that destroys the currency's value. Create too little money and the debt becomes unpayable and you get deflation and depression. There's no sustainable middle ground when debt levels are this high. We're trapped. So let me come back to the question one more time with full clarity. If every American is in debt, who's the creditor? The answer is we are, but also we're not. The system has been designed so that debts are owed to entities that created money from nothing, the banks, the Federal Reserve, and to entities that represent us, pension funds, mutual funds, insurance companies. We're borrowing from ourselves through intermediaries, paying interest to institutions for the privilege of using money that was created for the sole purpose of lending to us. It's the most elaborate confidence game ever created. Not a con in the illegal sense, but confidence in the sense that it only works if everyone believes in it. The emperor has no clothes, but as long as everyone agrees to pretend he's dressed, the system functions. The moment someone points out the obvious, that money is being created from nothing and debts are mathematically unpayable, the illusion shatters. I've spent my entire career working within this system, profiting from understanding how it works, positioning my investments to benefit from the money creation and debt expansion. I'm not claiming moral superiority. I played the game and played it well, but I also understand that this game can't continue forever. Eventually, the debt becomes so large, the money creation becomes so obvious that confidence breaks. And when confidence breaks in a debt-based fiat currency system, everything unravels very quickly. The signs are already appearing. The federal government is paying over $1 trillion per year just in interest, money that produces nothing, creates nothing, just services past debt. That's unsustainable. Commercial banks are sitting on hundreds of billions in unrealized losses on bonds they bought when interest rates were low. That's unstable. Corporate debt is becoming harder to refinance as rates remain elevated. That's dangerous. And the American people, the actual humans trying to live their lives and raise their families, are drowning in debt they can never repay in real terms. So when you ask who the creditor is, when you try to trace where all this borrowed money came from, you find yourself going in circles. The money was created from nothing by entities that have the legal power to do so, banks and the Federal Reserve. It was loaned to Americans who needed to buy houses, cars, education, or to a government that spent more than it collected in taxes. And it's owed back to those same institutions or to pension funds that represent future retirees or to foreign entities who believed in the system enough to lend to us. But ultimately, the entire structure rests on nothing more substantial than collective belief. Belief that dollars have value, belief that debts will be repaid, belief that the system can continue indefinitely. And that belief is starting to crack, not everywhere at once, but enough places that the careful observer can see the foundations weakening. The question isn't if this system will break down. The question is when, and how devastating the collapse will be when confidence finally, inevitably fails. Because when you build an entire economy on debt created from nothing, owed to entities that are ultimately just different faces of the same system, you haven't built anything real. You've built a mirage. And mirages disappear the moment you look at them too closely.